So with silver miners, you're leveraging leverage on top of leverage. And that's a great, high-powered way to play this macro trend and this metals trend.
We have a very special guest in the house right now. We have Brien Lundin. Good morning. How are you?
Doing great, Jim. Thanks for having me on.
We'll start with the gold question first. So every time we see a pullback in gold, everybody says the rally is over. This went too far, yet we've seen very shallow pullbacks. And when we look at retail flows, we've seen net positive flows in retail every month this year so far, which is something that we haven't seen in a very, 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 very long time. And so kind of what does this mean for the gold market? And is retail just late to this and we have further to go? What are your thoughts on this?
Yeah, great point, Tracy. This gold bull market is different from any other. Now, remember that gold traded as an investable asset only since 1971. Before that, it was simply money. So there really wasn't an investment per se. It was actually illegal to own in the US. So there's been, by my count, only 4 gold bull markets, this one included. The early 70s, the late 70s, the 2000s, and this one. Some people count the 70s as one big bull market. So it really is relatively new as an investable asset. But this market is different. This bull run is different than any other that there's ever been because it wasn't driven by Western demand or really even investor demand. It was kicked off primarily by central bank demand. And, because of that, there were a lot of unique characteristics. There have been a lot of unique characteristics to this bull market. Typically, you see mining shares participate and leverage the move in gold. Typically, you see silver leverage the move in gold. But that did not happen for much of this move, which is now about 14 or 15 months old. That's because central banks don't buy mining stocks. They don't buy silver. They buy gold. So gold started moving and the Western investors, retail and institutional, were kind of in disbelief and agog at some of the early moves and did not participate waiting for a pullback. And as you mentioned, all of these pullbacks have been very shallow because they have not been driven by, the typical swings in investor emotions, from euphoria to despair and back again. The swings in the market have been, again, unique from what we've experienced before because they're being driven by geopolitical considerations, by central banks, by nation states buying gold to gain independence from the dollar and the weaponization of the dollar. So pullbacks have been shallow. The central banks and sovereign states have been coming in on every decline. And it's really been interesting. As you say, we've started to see physical demand in the West. I kind of subdivide Western demand into retail and institutional. And I think the inflows into GLD, the big gold ETF, that's the best proxy we have for Western demand. I think that's been primarily institutional. I think, the typical retail investor tends to buy physical or really has an impact in the physical market. And that's been really just like crickets in the US especially. Very little physical demand, if anything, more selling than buying. But we started in last summer to see some Western flows into the gold ETF. And then we had a serious post-election correction in gold, really the only significant correction we had in this bull market. And now we're starting to see those flows into GLD again. The important thing to me is that we have seen since the beginning of this year, the mining stocks leverage gold in really the kind of the classic fashion that you expect. Gold went up about 16% in the first quarter, which led all other asset classes and sectors except mining stocks, which about doubled that performance. So we're starting to see Western investors come to the party, but instead of coming so much through gold itself, they're choosing to play it through the mining equities.
I am a big fan of silver, so I want to touch on that market a little bit. We've got the gold silver ratio. It's been over 100 for quite a while now. I think this morning we're a little bit over 99. A lot of people look to that market because that just means silver is that much cheaper relative to gold. So if we look at the technicals, the market's been coiling for a while. It looks like it's about to spring one way or the other. What are your thoughts on silver here?
Yeah, I tell people all the time, if you like gold, and you should, then you should love silver, because in every long-term bull market in gold, I mean, this is as simple a rationale as you get. In every monetarily based, in other words, a bull market in gold that's based on monetary concerns, inflation concerns, currency depreciation concerns, which is really the only kind of long-standing bull market in gold. But in every such instance, gold or silver has outperformed. It's leveraged gold quite significantly. So by virtue of that fact alone, I expect silver to dramatically outperform gold, in the months ahead. It has had a late start because, again, the beginnings of this gold bull market were unique. The interesting thing, if you look at currencies and assets as a share of international reserves, the dollar has actually been dropping, and gold over the past couple of months actually surpassed the euro. So gold is actually in second place, and that trend line is rising while the dollar is falling. It would still be a while at these rates before they cross, but gold is absolutely becoming a very important component of international reserves.
As future traders, how should we interpret the data like the CPI, inflation related data, maybe inflation 2.0 around the corner, who knows, maybe not. How could we use that to generate a bias for gold and silver price direction?
Well, the interesting thing has been for quite some time, and up until just recently, that the Fed drove the markets before we had the trade wars and the tariff kerfuffle. Everybody watched and interpreted the tea leaves as to what the Fed might be thinking, because that was the font of all the liquidity that drove all the markets. And so higher inflation was deemed negative for gold, bearish for gold, because it prompt the Fed to either raise rates or stand pat. And lower inflation was deemed bullish for gold. And this is absolutely opposite of what the classical interpretations had been forever. So these days, it's still in place to some extent, but the other factors like tariffs and their potential impacts on inflation, the potential for recession, et cetera, are some of the more important data points for the markets, and especially for gold.
Yeah, that makes sense. We have a little bit of time left, Tracy. Any last minute thoughts on your mind?
Yeah, I would like to touch on the miners a little bit, particularly silver miners, because they have definitely been lagging the market. So I'd like to get some insights on the miners a little bit from you.
Yeah, the silver miners in particular, or in general?
Silver miners in particular, but general as well.
Yeah. Yeah, the silver miners are a rare breed. There's not that many big silver producers. 70% of silver production is actually as a byproduct of other metals, primarily zinc. So there's very few relatively pure ways to place silver through the miners. And the ranks of those miners are really narrowing, because there are mergers, big mergers happening. One that was just announced yesterday or the day before. But I think the silver, I like silver. It leverages gold. I think I know silver miners leverage silver. So if you like the fundamental macro story, if you believe that gold still has a long ways to run, as I do, then you can leverage those moves with essentially unexpiring call options on silver and on silver miners. So with silver miners, you're leveraging leverage on top of leverage, and that's a great high-powered way to play this macro trend and this metals trend. Generally speaking, gold miners are another great way to do it. They are absolutely spitting out cash right now, and by every measure, they remain seriously undervalued, significantly undervalued, especially in relation to where the gold price is. So lots of torque available in the miners, I think, now.
Very awesome. Brien, thank you so much for spending time with us this morning.
Great to be
Thank
with y'all.
you.
Thanks so much.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.